Okay, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be showing you the two main ways you can trade the current inflation crisis. Although if you ask me, I don't personally believe it's a crisis, at least as of yet, but it certainly could develop into something much more serious in the near future. And you can either play into the increase in inflation or you can play against it, or both. And so those two things I'll be showing you in this video. Now, very quickly before we get started here, for those of you who are new to the channel, I just want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. Okay, so now diving in here, and like I said, there are two main ways you can play the inflation crisis, if you want to call it that. The first of which is to play into the crisis, to play into the increase in prices across the board. And generally speaking, the kinds of products we are seeing increase in price the most are commodities. And this is a pretty basic article I pulled up from Investopedia, and it does outline pretty well how to use commodities as a hedge during inflation. Because oftentimes, like we're seeing currently, the prices of commodities increase drastically during times of inflation. And there are two main reasons for that. So if I scroll down here, and if I zoom in a bit, this sentence is very important. As the demand for goods and services increases, the price of goods and services rise, as does the price of the commodities used to produce those goods and services. So what does this mean exactly? Well, currently we're seeing a massive influx of cash into our economy, right? The Federal Reserve, in the case of the U.S., is printing trillions and trillions of dollars and just injecting that into the economy with the goal of trying to continuously stimulate the economy throughout the COVID crisis. And so what does all this easy money and also very low interest rates mean? It's going to drastically boost the demand for goods and services, right? Obviously, with the stimulus checks, for example, for individual people, the idea there, of course, is for those people to use that money to go out and buy goods and services. And in the case for individual companies, they can borrow as much money as they want for very little cost, right? Because interest rates are basically zero. And those companies can use that extra capital to purchase more commodities, more inputs to produce their goods and services, which in turn drives the prices of commodities upward. It's all about increasing demand, both for the final product, the final good or service, and also the inputs used to produce those goods and services. And the second major reason that commodities often do well during times of inflation, and we'll go to the GLD chart real quick, right? GLD is an ETF that tracks the gold market, and this is one form of commodity where the idea is if you are concerned about your currency becoming worthless because of inflation, then you can put your money into commodities or precious metals like gold and silver, or other products that will hold their intrinsic value outside the scope of human currency. Right? For example, the main concern nowadays is that we're going to experience hyperinflation, that prices for goods and services are going to skyrocket so much that the value of the dollar is going to be basically worthless. And this is something that Germany experienced after World War I, where basically the prices of goods and services were pushed so high that a single loaf of bread would cost thousands and thousands of German marks. But that's all man-made currency. In the case of things like gold and silver, which has value and utility across the entire world, right? You can exchange pretty much anything for gold or silver, right? For example, if I wanted to, let's say, purchase your watch from you, instead of giving you a few thousand US dollars, I might give you some gold. And then you can use that gold to go buy something else. So again, the point I'm making is certain commodities like precious metals, for example, transcend human currency. So that's why during times of inflation, you often see very large increases in the price of gold and silver because now a lot of people are buying those assets as a store of value. So ultimately here, if you do want to play into the inflation game, then you can start buying assets that track certain commodities. So if you want to buy gold, you can buy GLD. If you want to buy silver, you can buy SLV. Right? This is an ETF just like GLD that tracks the silver markets. And it has a very similar story. The price of silver has absolutely skyrocketed since the beginning of all this printing of money. There's also been a lot of news stories about the value or price of timber going up very quickly. So if you wanted to buy into an ETF that tracks timber, you can buy shares of WOOD. And again, very similar story. What about the energy and gas space? If you think the prices of energy, generally speaking, are going to increase across the board, well, you can invest in things like XOP. And don't worry about trying to memorize all these ticker symbols and ETFs. I have all this information in the description of this video below as well. And so I'm just showing you a few examples of different ETFs you can buy if you want that track different sectors and commodities, but I would also recommend you do your own research as well. And lastly, in regards to this first main approach of trading the inflation crisis, you can also buy shares of individual companies that are very closely tied to certain commodity markets. So in the case of steel, for example, you can buy shares of SLX. This is an ETF that allows you to invest in steel on a general basis. Or you can buy shares of just X, which is an actual company called US Steel. Or same thing with copper now. You can buy shares of COPX, an ETF that tracks the copper markets. Or you can buy shares of FCX, which is a company called Freeport-McMoRan Incorporated. And this company is involved in the mining of copper. So it's up to you. Do you want to go with ETFs that are a bit more diversified, give you broader exposure to the entire steel or copper markets? Or you can invest in individual companies within those spaces. So that's the first main way to play the inflation crisis, playing into the crisis. The second major way is to do what Mr. Michael Burry is doing and playing against it. And in case you don't know who this guy is, Michael Burry was the guy who shorted the housing market before the 2008 crash, and he made billions off of that. Right, he basically saw before anybody else that people were going to start defaulting on their mortgages. Right, because during that time, back in 2008, mortgages were being handed out to pretty much anybody who asked for them. Regardless of income, regardless of credit score, if you want a mortgage, just ask for it, here you go. And so eventually he was correct, and people started to default on these mortgages on a massive scale, and the whole housing market came crashing down. And so now in 2021, this guy is saying that inflation is going to skyrocket. This is only the beginning that we're experiencing now, and he's already placed massive bets actually against inflation. He's basically saying that inflation will get so bad that the Federal Reserve will have to step in. It'll be forced to make a move and combat this inflation. And if that happens, I'm sure he would make many more billions. So what specifically is he doing? Well, let's go to the TLT chart now. And this is an ETF that tracks 20-year U.S. Treasury Bonds. Basically, they're just long-term bonds issued by the U.S. government, and they're directly tied to U.S. interest rates. And this is where things can definitely get a bit more complicated, but I'll try to summarize it here in a very basic fashion. And that is, when inflation skyrockets, the way the Federal Reserve can combat inflation is by increasing interest rates. And the price of bonds in general, not just treasury bonds from the government, but any form of bond, the prices of bonds are inversely correlated to interest rates. So when interest rates go up, the price of bonds go down. So again, the full picture here is inflation goes up, then the Federal Reserve increases interest rates, which then causes the prices of bonds to go down. So what does that mean here for TLT, an ETF that tracks the prices of 20-year Treasury bonds? Well, it simply means if you're like Michael Burry and you think inflation will get so bad that the Fed will have no choice but to step in and increase interest rates, that means you're going to want to place a short position on TLT. Now, I would not recommend actually shorting this ETF because when you do short shares of anything, you do have undefined risk, right? Because if you're wrong and TLT skyrockets for some reason, there's no limit as to how high TLT can go, which means if you are short TLT, then there's theoretically no limit to how big your losses could be. So instead, what I would do is buy put options on this ETF. And I know that's a bit unusual for me to say because I pretty much only sell options, but this is a very special, unique situation. And I'm not saying I'm going to do this, but if I were to do it, I would buy a put option with a very far out expiration date, right? I might go all the way out to January 20th of 2023. And even with these options expiring years from now, they're not that expensive either, right? Even the at the money put option on TLT is trading for only about $1,500, somewhere around there. And if you just go a bit out of the money, maybe to the 125 strike, these options are only $800. But for me, I would probably go a bit in the money just to be extra safe. So maybe something around the 150 strike for around $2,000. And this would give me defined risk, right? So even if I'm totally wrong the most I could lose is simply the value of this contract, $2,000. And the main reason why I would go so far out in time is because there's no way to know if and when the Fed is ever going to have to step in and be forced to increase interest rates. It could happen tomorrow, it could happen in 6 months, it could happen in a year. There's no way to know. So even if I am right at some point, if my option here expires before then, I'm screwed. So anytime you're making some big bet on a particular event happening, you have to, one, get the event actually correct, and then two, you also have to get the timing correct, which is why this kind of stuff is so difficult. But at least in regards to the timing aspect, you do have the ability with options to go very far out in the expiration cycle to give yourself as much time as possible. And this is actually one of the positions that Michael Burry has on currently. He's placed massive put positions on assets like TLT and other ETFs that track bonds. So if you want to also get on board with his particular approach, then this is definitely one thing you can do. But finally here, if you don't want to deal with options at all, if you just want to buy shares of something, then perhaps you can look at TBT. And that's because this is also an ETF that tracks 20-year treasuries, but it's the inverse. It's basically the inverse of TLT. So one more complexity to add into the mix here. So the full picture in regards to TBT is inflation goes up, and then as a result, the Fed is forced to increase interest rates, which then causes the prices of bonds to decrease. And that's why TLT would decrease in that situation. And then for TBT, being the opposite of TLT, the price of this ETF is going to increase. So this would be a good candidate if you still wanted to play against inflation in the same way that Michael Burry is doing, and he does also have positions on this ETF as well. But this would also allow you to simply buy shares of TBT and be done with it. And then you can hold those shares indefinitely. There's no expiration date. And it's also definitely a very cheap ETF, so it's widely available to most people. So I believe that's going to do it for today's video. Again, you can either play into the inflation crisis, you can buy shares or buy call options on various assets that track commodity prices, and or you can also play against inflation by betting on the increase in interest rates. And I say and or because you can technically play both at the same time if you wish. Just understand though that if the Fed is forced to increase interest rates, then that means the prices of commodities will likely drop very sharply. So if you have any long positions in commodities at that time, you'll probably want to get out. But with that being said, I hope you enjoyed this video, and please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.